Hello and welcome to this first module. Today we'll explore how to finance your buy-to-let property beyond its standard bricks and mortar value. We'll cover key concepts including freehold property, leasehold property, commercial leases, and shops with or without upper parts. Let's begin by clarifying these terms to ensure a solid understanding. Freehold property. Owning a property outright, including the land it stands on, with complete control over its use and any modifications. Leasehold property. Holding the right to occupy a property for a specified period under a lease agreement while the freeholder retains ownership of the land. In residential real estate, properties are typically either freehold or leasehold. However, in commercial real estate, these concepts can intertwine, potentially enhancing a property's value. Combining freehold and leasehold in commercial property. Enhanced property value. A freehold commercial property with an existing lease to a tenant can command a higher market value. The lease agreement, especially with a reputable tenant, adds investment security, making the property more attractive to investors and lenders. Separate transactions. In commercial real estate, the building and the lease can be sold independently. You can sell the property with the tenant in place, transferring the lease to the new owner without the tenant's consent, as the sale pertains to the building, not the tenant's business. Lease continuity. Upon selling the property, the existing lease remains in effect until its expiration. There's no need to negotiate a new lease immediately, ensuring stability for both the tenant and the new owner. Understanding these dynamics allows you to leverage lease agreements to enhance your property's value, facilitating better financing options for your buy-to-let investments. When evaluating commercial properties, the presence and quality of tenants significantly influence the property's value. Here's an enhanced example illustrating this concept. A vacant commercial property is listed for £200,000. Our first case is a start-up business tenant with an annual rent of £25,000. The assessed risk yield is 15%, reflecting the higher risk associated with a new business. The valuation calculation. Well, this is the property's value determined by dividing the annual rent by the risk yield. So £25,000 divided by 0.15 equals £166,667. Now in this scenario, the property's value is approximately £166,667. To purchase it at the asking price of £200,000, a buyer would need to provide a deposit of £33,333. Our second case is an established FTSE 100 company tenant. The annual rent is £25,000. The assessed risk yield is 6%, reflecting the lower risk due to the tenant's strong financial standing. For the valuation calculation, we use the same formula. £25,000 divided by 0.06 equals £416,667. So here the property's value increases to approximately £416,667 due to the lower risk yield. For the financing implications, well, with the higher valuation, a buyer can leverage this increased equity. The purchase price is £200,000. The mortgage is 60% of the valuation, so £250,000, 60% of £416,667. The equity release, £50,000. That's the mortgage amount minus the purchase price. This equity release of £50,000 is tax-free as it originates from the loan, providing additional funds for the buyer. Now this example demonstrates how tenant quality and associated risk yields can substantially impact a commercial property's valuation and financing options. Thanks for watching. We'll see you in the next module.